Okay, in Chapter 6, Part 1, I want to take a look at this problem, problem number 3. Here we have Geraldine is an accrual basis taxpayer who has the following transactions during the current calendar tax year. So we've got some information that's given to us there, and we want to calculate Geraldine's net income from her business for the current year. Seems really straightforward. There's just one item on here I think that could easily trick us up. So let's look at it. So let's figure out her net income. First, let's plug in the income other than rental, which is given right here, her accrued business income, which means that this taxpayer is, again, an accrual basis taxpayer. Accrual basis was the method of accounting that you learned in financial accounting. Different than cash basis accounting, obviously. And let's see, $220,000. What was the income from the rental? $21,000. And since those are the accrued, or this one was the accrued income. And then this one, this is rental income on a building leased for the next 6 months received on December 1st. So what we need to pay attention to here, and what this problem is trying to make sure that we can distinguish, is when an accrual basis taxpayer, first of all, recognizes income. Remember from your financial accounting class that accrual basis taxpayers recognize, meaning record it, put it on their financial statements as income. When the income has been earned, meaning the work has been done and collectability can be reasonably assured, and we also know the amount. So in this case, this is money that has been prepaid to us by our tenants. So the way the IRS looks at that is they don't say, well, since this is for 6 months and only 1 month of it is actually in this tax year, you only have to pay taxes on 1 month. The IRS does not look at it that way. They say, even though only 1 month of this is going to get recognized in this particular calendar year, and the next 5 is going to be in the other calendar year, because you actually received the money in cash, we want you to pay taxes on it now. So when it's income that has been received in advance, all of it is reported for tax purposes, but then it's different for expenses. So let's fill out our expenses here. Our expenses other than rental were $170,000. And then here's the part that can be tricky. So we have prepaid rent expense for 6 months paid on December 1st. So even though we have 6 months worth of an expense that went out the door, the IRS doesn't look at that the same as they did that rental income that we had received. They say, well, even though you paid the whole amount, only 1 month is actually for this year, so that's all we're going to let you deduct. You're going to have to wait until next year to deduct those additional 5 months worth of expenses. Kind of interesting how it works that way, right? Like they want the income reported right away so they can get the money, and then when we have expenses, they say, no, you can wait on that. So what are we going to show here for this amount right here, this prepaid rent expense? Well, we don't get to show the whole $9,000. We are going to only show 1 month of that because it was paid on December 1st. So all we get to deduct for tax purposes as an expense is 1 month's worth. So we could calculate that by taking $9,000 and divide it by 6, because that's the number of months. So for the month of December, we would get to deduct $1,500. The rest of it, that other $7,500 of expense for this item right here, doesn't get to be shown or deductible as an expense until the future tax year or the next tax year. So our net income here is $69,500. Okay, and then there's one more thing that I wanted to look at here. I didn't assign this problem, but I thought it was just something interesting to point out. So here, this is about unearned income of minor children and certain students. So they're asking, what is the purpose of the provision in the tax law that taxes unearned income of certain minor children at the trust and estate tax rates? So when they're talking about unearned income, they're talking about whenever minor children have unearned income, it's because their parents are wealthy and because there's a trust, an estate, their parents, their grandparents, whomever is transferring money to minor children. So the reason for that, the reason why that unearned income of minor children is being taxed at this trust and estate tax rate is because they are trying to prevent any taxpayer from transferring income earning assets generally to a dependent child in order to take advantage of the child's lower tax rate. So if the parents are making tons and tons of money and they're at the highest income tax rates and they're trying to figure out a way to avoid paying taxes and to save some money, if they were able to transfer some of those income earning assets to their children, then effectively less taxes would be paid. So that's the reason for this. That's why that unearned income has to be taxed at the trust and estate tax rate, according to the IRS, is because they're trying to prevent people from trying to get around things. So there's a lot of people out there that spend a lot of time and energy figuring out how to avoid paying income taxes. Super wealthy people are the ones that do it the most. So a lot of times they pay lower tax rates than even normal people like you and I that actually work for a living. And then as people are doing that, the IRS is also looking at all the ways that people are going to try to avoid paying taxes, and they try to come up with ways for people to avoid it. So that's what's going on with this one. Okay, that's it for Chapter 6, Part 1.